Hey everybody, my name is Lori Page and I lead the advisory team here at Sound Wealth Management. For many people, retirement is not a time to slow down and stop. It's a time to explore the next great chapters of your life and build upon everything you've learned and experienced so far. Unfortunately, another thing that doesn't slow down or stop is taxes. Understanding how taxes could affect your future cash flow will help you to create an effective retirement income strategy. In this video, we'll look at how doing some tax planning now can pay off later in retirement. So let's start by discussing how your retirement savings accounts are taxed. Withdrawals from traditional 401k plan accounts and certain other employer-sponsored plans, as well as traditional individual retirement accounts or IRAs, will generally be subject to federal and state ordinary income taxes upon withdrawal. On the other hand, contributions to a designated Roth 401k or Roth IRA are federally tax-free when you withdraw those funds, as are the earnings, assuming that the withdrawal is a qualified distribution, which generally means it's made after a 5-year waiting period and the account owner is 59 and a half years or older. As for your non-retirement accounts, bond income and some of the dividends that you receive from stocks and mutual funds may be taxed at your federal ordinary income tax rate, but qualified dividends and long-term investment gains are generally taxed at lower long-term capital gains rates. State and local tax treatment may vary. So this requires developing a thoughtful distribution strategy. For some people, it'll make sense to consider tapping taxable accounts first, then tax deferred. But depending on the circumstances, this order may not be right for every person. If most of your investment gains are from long-term assets held outside of a traditional 401k, IRA, or other similar tax-deferred accounts, you'll likely pay long-term capital gains taxes, which are generally lower than what you pay on distributions taxed as ordinary income from your tax-deferred retirement accounts. You'll also need to consider the impact of your retirement savings on your taxes once you reach age 73 or 75 after 2032. That's when you must begin taking required minimum distributions or RMDs from some of your retirement accounts, which is likely to boost your taxable income. It's prudent to consult with an advisor or tax professional regarding retirement income and tax planning strategies. So now let's talk about how to avoid moves that could put you in a higher tax bracket. RMDs and other changes that bump up your income can result in what's called bracket creep, which is unintentionally slipping you into a higher tax bracket. For example, you might receive an inheritance or sell some real estate. You might also slip into a higher tax bracket by taking a large distribution from a taxable account to renovate your home or buy a new car. A higher income can also affect the taxability of your Social Security benefits and increase your Medicare premiums. This is one reason you may want to consider funding different kinds of retirement accounts during your working years. For instance, you could diversify your retirement contributions and split them between Roth and traditional pre-tax allocation. During retirement, you can manage the amount of taxable income you receive and make adjustments when necessary. You can also pay for qualified medical expenses during retirement with any health savings account savings that you may have. Those qualified withdrawals are tax-free and won't affect your taxable income. For more information or to discuss your specific scenario, feel welcome to reach out to the Sound Wealth Management Advisory Team by calling 941-932-4822 or scheduling your no-obligation consultation online at www.soundwealth.net, where it's time for you to be heard. Have a great day, everybody.